Good morning, everyone. I think that's 11 o'clock, so we will kick off the second of Angus and I's autumn webinars. For those who weren't able to join us last week or the topic wasn't appropriate, I'm Ian Parker, Director of Whitley Stimpson, and co-presenting with me is Angus Aston, Director of Wise Investment. This webinar focuses on the basic principles and rules behind inheritance tax before moving on to look at how you could perhaps consider starting the process for some estate and inheritance tax planning before we then finish off covering a few of the more commonly used inheritance tax mitigation and estate planning tools. Before we dive into the detail, I'll let Angus just give a brief overview as to Wise Investment.
Thank you, Ian. Morning, everybody. So Wise Investment is 31 years young, having been founded in 1992. We are an employee-owned business, which means that all our staff have a stake in the success of the business and therefore incentivized to look after our clients well. We're definitely keen on getting to know people over the longer term. We think that's how we can best help them rather than sort of one-off pieces of advice. And our key areas are pensions and retirement planning, managing investments, and then eventually helping people manage the transfer of their assets usually to their children, and along the way we'll sort of bolster things with protection advice and so on. So that's the sort of central part of what we do. We have about 900 or so clients, many of whom have been with us since the 90s. So that's us. We're very firmly local, having been founded and still based in Shipping Norton with just the one office.
Brilliant, thanks, Angus. And just to give a little insight into Whitley Stimpson, there's a lot of overlap between ourselves and Wise in terms of our ethos and cultures. And again, we're very much focused on long-term client relationships. We're now in our 92nd year. We've got 4 offices sort of spanning the Thames Valley in Banbury, Bicester, High Wycombe and Witney. We offer a complete holistic approach to our advisory services. So whilst we do offer all of the usual compliance services, tax returns, statutory accounts, audit services, etc., we also offer the tax planning and advisory side, which we think allows us to build even deeper relationships with our clients. A little bit of housekeeping before we dive in, just to say the boring legal jargon. The content of the presentation represents Angus and my personal views and must not be construed as financial or investment advice. Everything that we say today is based on our current understanding and may be subject to change in the future. And clearly, as it says there, past performance is not an indication of any future performance. So really, hopefully the webinar will give you some insight into estate planning and IHT, but please do pick up with us if you have any more in-depth or specific queries. The format for the webinar today will be that I expect the main presentation will be somewhere 45-50 minutes long. There is quite a lot of content in here, but Angus and I will do our best to avoid waffling. And then there should be time for a Q&A session at the end, hopefully looking to wrap up just under the hour. So with that, I will kick off into sort of where are we with inheritance tax, because I think that gives quite a useful backdrop to show the current IHT landscape. So inheritance tax is becoming an increasingly valuable source of funding for the government. Inheritance tax, as we know it today, has been in place since March 1986. And I think most people are fairly familiar now with the basic principles and the current nil rate band that everybody has of £325,000, which has now been in place for 14 and a half years. It was increased to 325,000 in April 2009 and hasn't moved since, which is actually quite a big part of the driver behind why these IHT tax take figures are increasing each year, because inflation and everything else means that more and more people, along with rising property prices, are being dragged into inheritance tax paying estates. I was quite surprised at the number of estates that are now within the remit to inheritance tax. Looking back at a couple of years, 2021, there were just over 27,000 estates during that tax year that were required to pay inheritance tax, and that's versus just under 18,000 10 years ago. So that is a sizable increase over the last 10 years. And actually, when you look at the effect of inflation, £325,000 in 2009 is worth just under £420,000 today. So you can see that by not increasing that threshold, the squeeze is there.
Yeah, there's obviously, so that chart's sort of tracking the increase in the actual inheritance tax take, isn't it? And there's been this acceleration in the last couple of years, and it looks that very likely the Office for National Statistics reckon that it by 2027, 28, it'll be up to 8.5 billion, but I've heard other people suggest that there's likely to be more. So by that stage.
And we do hear rumours that IHT might be on the way out or due to be abolished, but looking at that tax rate, it's quite hard to believe, isn't it, really, Angus?
Yeah, I mean, this is good sort of marginal revenue for the Treasury, and as we know, money's tight, and so they probably can't afford to give it up. Although contextually, the same ONS figures seem to suggest that income tax is going to be something like 320 billion in 2027, 28. As much as you can trust forecasts like that. So there's been a campaign in some parts of the press to say we should now just abolish inheritance tax, without really giving a particularly good reason why, for discussion, but maybe not for now. My own view is that it's unlikely to be scrapped. It could be something that Conservatives put in their manifesto as a to keep their sort of core vote on side. We shall see, but I can't personally see inheritance tax being scrapped, whatever the manifesto might say.
Absolutely.
Happy to be proved wrong.
Aren't we all? So a whistle-stop tour now of the basic principles of inheritance tax. So as I've already said, everybody gets a nil rate band of £325,000. On top of that, coming out of the last general election, is this residential nil rate band of now £175,000. It was tapered in over a number of years, but we're now up to the full level of relief, which is 175,000. And that is applicable if you leave your main home to direct lineal descendants and your estate is worth less than £2 million. There is clearly an awful lot more detail within the residential nil rate band than that, and we could probably do a separate webinar solely on the residential nil rate band, but they're the headline figures. So actually, when you then combine those two bands, you get to a point where each individual potentially has £500,000 they can pass on free of inheritance tax on passing. So for married couples, that obviously doubles up to the £1 million headline newsworthy figure that was in the last manifesto, and that's really been bandied about. So that's where that million, you can now leave £1 million tax free. That's where that comes from. Clearly, anything that's subject to inheritance tax, which is broadly it's most assets. So for a typical UK resident domiciled individual, it is most of their worldwide assets, property, stock shares, investments, cash balances, etc., including ISAs, which is quite a common misconception that we see. The one thing that isn't within the remit to inheritance tax at the present time are pension funds. So pension funds are outside of IHT. So anything you've got that exceeds the bands there is subject in its usual guise to inheritance tax at 40%. Actually, if you decide to leave more than 10% of your estate to charity, then it does reduce the rate of inheritance tax by 10% as well, reducing it down to 36%. So that's always something to just think about when having discussions around wills, etc. Looking at the most common exemptions from inheritance tax, for somebody like myself who spends over half their time dealing with farming and agricultural clients, I had to put agricultural property relief at the start. For those who are involved in farming and agriculture, they will have an awareness of this relief, and it is incredibly valuable. The Office for Tax Simplification and the Treasury are playing around with the edges of agricultural property relief at the moment. So the most recent change that's now been passed as legislation is that from April next year, agricultural property held elsewhere in the European Economic Area, the EEA, no longer qualifies for agricultural property relief. It is only UK-based agricultural land. And they've just finished a consultation around let agricultural land that's let on farm business tenancies, which I won't bore you with today, but they are playing with the edges of that. Outside of that, you've got the annual exemption. So each person can give away £3,000 a year. That's in aggregate. That's not to specific individuals. You can't give more than 3,000 and benefit from the annual exemption. And if you didn't use that exemption in the previous tax year, then you can go back 1 year as well. So potentially you can give away £6,000 in a year. Business relief, Angus is going to talk about a bit more later on, but typically that's if you own your own incorporated trading company, or certain types of investments, which, as I say, Angus will cover. We've got small gifts of £250, regular gifts out of income, which is covered later on, and then that's put there the marriage gifts, and the three thresholds. £5,000 is to a child, £2,500 is to a grandchild or a great grandchild, and then £1,000 is to anybody else. So if you've got friends that are getting married and you're feeling very generous, then that's the maximum you can give away without having to even think about inheritance tax implications. I've then differentiated there are potential exemptions, and these are if you make larger gifts to individuals, so over and above the £3,000 exemption, and gifts into certain trusts. And broadly speaking, they are potentially exempt because from the date the gift is made, it starts a 7-year clock ticking. If you survive 7 years, then the gifts will fall outside of your estate and be exempt from inheritance tax. And if you don't survive the 7 years, then they might be dragged back into the estate. That's probably a whistle-stop summary, isn't it, Angus, of the...
It is, and I think that's probably as far as we should go for the moment. We'll delve into a bit more detail and try not to get lost in the weeds as we go along.
So we've got here basically who needs an estate plan, and the short answer is everybody. That's because whilst not everybody will have a very sizable estates and may not even have inheritance tax issues, actually, as you can see from this picture, there's an awful lot more to estate planning than just the financial aspects, which clearly we're focusing on today. but Angus and I can't stress enough the importance of actually getting everything into order, make order out of the chaos, and the importance of things such as up-to-date wills, powers of attorney, etc., etc. So whilst we won't focus on those today, we did just want to highlight that estate planning is a far bigger picture than just the financial aspects.
Yeah, I think I'd add to that and say that once you start delving into it, it can get quite complicated. You've got decisions to make as to who you might appoint as attorneys, who you might appoint as executors, where you'd like your assets to end up, and these things might change over time. So focus on it, take your time over it. Do get advice, of course. I'm going to mention solicitors who generally do a very good job in helping people make these decisions and put everything in place. And the other thing is, probably if you have adult children, is to at some level involve them so that they know what's going on and where to find this and that piece of information, and sort of, as far as you are willing to share this information with them, where your money is and what they need to do, because that will just make everyone's lives a great deal easier now and in the future.
Absolutely. I think I always say to people, you have to see it as an ongoing process. It's not something you can do once and say it's done.
Correct. Yeah, absolutely. Yeah.
So we've talked about the process there, Angus. What is the process?
So if a client comes to us and says, actually, we can we look at this inheritance tax situation, the first thing we'd be saying to them is, have you made a will, and have you set up lasting powers of attorney, and direct them to probably to a solicitor if they haven't done so. But then, as far as the sort of planning how you manage it, we're going to have a fairly lengthy conversation establishing sort of where they are, how they've got here, what their hopes and aspirations are for the future, tot up their current assets, any liabilities, and so on. Work out actually, as it stands, what would be the inheritance tax cost today. Give a great deal of thought to what they're going to need during their lifetimes, including sort of potential cost of care, which is one of these unknowns. Some people never need it at all. Other people may end up spending quite a lot of money on it. Very importantly, we need to look at what sort of level of investment risk and other types of risk they're willing to bear, relating to how sort of secure or guaranteed their income is, and so on and so on. And then from there, we can sort of put together a jigsaw of options, strategies that can be put in place either immediately or over time to, well, transfer assets if that's what's required, and to potentially mitigate the inheritance tax liability. So yeah, it's not as Ian you just said, it's not a one-off event, and there's a lot of detail to work through. So we thought we'd look at a notional couple who are getting their act together on what's sometimes called intergenerational planning. Michael and Andrea Smith, who are basically still in their relatively early years of retirement. They're in good health. They've saved hard, bought a house, paid off their mortgage, and Andrea has had a business which is just sold and received, net of any tax due on the sale, 1.2 million, which is very nice. And they also have stocks and shares ISAs of about £250,000 that they built up over time. And then separate from that, they both have pension funds, and you can see the figures on the screen there. And as Ian pointed out, the pension funds are not subject to inheritance tax, but they might be subject to other taxes, and we covered that in a bit more detail last week. Very conventional family, they have 2 adult children, and that's who they would like to leave their money to. Key point on the bottom left is they need that level of income stated there for their own purposes during their lifetime. So that's anything to add on the background, Ian?
I don't think so. I think you've covered in terms of what they've got, and as we say, I mean, this is just by virtue of the ages there, linking back to what you said earlier, Angus, the level of income that they would like, that obviously doesn't encompass at this stage the requirement for any care fees. So, and just touching it, as you said, you know, should they need those in later life, then clearly that figure might well change. And that's just a prime example of things that can change as they work their way through retirement. So,
right. So
sort of thinking back to your process earlier on, it's quite useful at this stage, having understood the background, to then look at what the current inheritance tax position is, just because, as you say, people have different attitudes to inheritance tax, and sometimes you get the response, actually, that's absolutely fine, I'm going to leave everything as is, and some people say, I don't want to pay a penny, and probably the majority is somewhere in the middle. So it's always quite useful to calculate the current inheritance tax position at the outset, just because that can be a driver in some of the decision making. So here, and I won't go back over all of the figures, but excluding the pensions, the total assets subject to inheritance tax to 2.45 million. This is all done on the basis that Michael and Andrea have mirror wills. So on one of the first one passing, everything passes to the surviving spouse, and then this calculation is taken upon what would happen if the second one were to pass away. So by the time you've taken off their various nil rate bands, you're left with a taxable estate as shown there, an inheritance tax liability of £670,000. So a sizable figure, and something that I think Michael and Andrea are keen to work on, really, isn't it?
Yeah. So just to add to that very briefly, so that what it means is that not counting the pensions, the net estate is something like 1.78 million, something like that, after the tax is paid. The other point briefly on the residence nil rate band gets tapered when the value is above 2 million. So 2 lots of residence nil rate bands is 350. You lose £1 for every 2 over 2 million. I'm rattling through it. So 450,000 over 2 million results in a reduction of 225,000, which gives you 125,000 of the residence nil rate band available. Trust us on the figures. If you want to work through it, then please give us a bell.
Oh, absolutely. As I said earlier, we could almost certainly do a separate webinar purely on the residence nil rate band and some of the nuances with it. And that's just an example, as Angus has given there, but that's really useful to understand. And then looking at their income position as things stand at the moment as well. The eagle-eyed among you, don't worry, I don't know something you don't. The state pension amounts that are shown on screen, they are both circa £1,600 below the current full state pension that somebody might expect, purely for illustration purposes and to make the maths a little bit easier for my little bare brain. So we've got Michael and Andrea both having a state pension of £9,000 each. As was mentioned earlier, they've decided not to touch their personal pensions at all at this stage. they have some income from their stocks and shares ISA portfolio, which is tax-free. And because of the sale of the business, they're receiving actually quite a lot of bank interest at the moment, particularly with the interest rates increasing. So they're receiving 25,000 bank interest a year. So they have a combined income of £50,000, which less income tax liabilities between both of them of just under 1,200 leaves them with 48,828 as net joint income. So
more than enough, well over their current target or requirement.
Absolutely.
Okay, so cutting a long story short on the discussions that we've had, they do want to try to reduce that tax bill. They want to help their children now because their children's mortgages have just got more expensive with the change in the interest rate environment. And they still want to make sure they retain some assets that they can access if they do have increasing care costs later on. So the various options that we settle upon are potentially lump sum cash gifts now to their children. There are various types of investments that could be made that qualify for business relief, which Ian mentioned earlier, and we'll look at that in more detail in a moment. There's a discounted gift trust, is a slightly more complex arrangement, which will allow them to park assets in a trust, taking advantage of the 7-year rule, while also retaining a right to receive a regular income. They may also be able to give away amounts every year or every month to their children. That is the difference between their income and their spending, and we're going to look at that again in more detail later on. But for the time being, they don't need to draw any income from their pension funds, and at the moment, the tax treatment of pensions is better than the tax treatment on death of other assets. So that's the broad picture of what's been decided.
So I'm going to kick off and look at the lifetime gifts. Michael and Andrea, they've decided to give both of their children £100,000 each. As I've mentioned earlier, because of the 7-year period that is then triggered, these are what classed as potentially exempt transfers. So they become exempt as long as the 7-year period is survived. Given the ages and the fact they're both in good health, the balance of probabilities suggests that should be a wise move to make. Just something that is worth noting. So cash given to individuals is always a potentially exempt transfer, and therefore you can actually give away more than the nil rate band. That's something that's quite commonly sort of misunderstood when I'm talking to clients. I think I can only give away up to the 325,000. That's the case with some assets, but not with cash. So that's just something to be aware of. And then, depending on the size of the gift, you could also consider taking out an insurance policy to cover that 7-year period if you wanted additional protection over any inheritance tax payable. Now, that's a real rabbit warren that I'm not going to dive down today. But Angus, I think you're in the same boat as me. A really common question you get asked is, if we don't survive the 7 years and we've made this sort of a gift, actually, who would pay the inheritance tax if these were to fail?
Right. So the process is that the gifts are declared in the inheritance tax return as part of the submission to gain permission, what's called grant of probate, to then release the estate and allow everything to be distributed. So they're simply taken into account in the tax calculation, and the tax ordinarily is due while the estate's being administered. So it looks likely in this case for Mr. and Mrs. Smith that there'll be enough money in the estate anyway to pay the tax. So sort of it boils down to it essentially reduces the amount the beneficiaries will eventually receive, but their children don't need to sort of delve into their pockets to find this specific amount of tax, even though they've received £100,000. I hope that makes sense. But ultimately, it comes back to the administration of the estate.
It does, and I think that's the key point. Actually, is that quite often after a gift like this, I sometimes get a slightly worried phone call from one of the children who might be saying, "Oh, I was going to use the money to pay off my mortgage, for example. Am I okay to do that, or do I need to keep the money back for the inheritance tax?" And actually, as you've just said, okay, you have to look at each scenario, but certainly with Mr. and Mrs. Smith here, the children wouldn't be expected to put to have to find that money themselves.
Yeah, I mean, if it was a very substantial gift that sort of far outweighed the remaining estate, so that the taxes arising from the gifts were that much more than was left in the estate to enable the payment of tax, then yes, maybe. But
yeah,
that's probably quite unusual.
I think you're right. It's not something that we see very often. So
right. So
go on, Angus. Sorry.
Yeah. So part of the plan is to invest in assets qualifying for business relief, which in brief is if you own a business relief asset for at least 2 years and continue to own it on death, you can claim 0% inheritance tax on the value of that asset. And we come across, well, two main types that we advise people about, which are there's a junior stock market in the UK called the Alternative Investment Market, shortened to AIM, and shares of trading companies that are listed on AIM are normally benefit from business relief. Pros and cons, you could get capital growth, but equally they're potentially quite volatile. So there is the risk of capital loss as well. But they do have the attraction of being relatively liquid, so you can sell the investments if you need the money. Also, theoretically, Michael and Andrea could transfer some of their ISA stocks and shares ISAs into AIM shares and benefit from the ongoing sort of capital gains and income tax relief within the ISA and get the inheritance tax relief. There are also other schemes that we come across where essentially you buy shares in an unlisted company, and typically they will own sort of fairly steady long-term assets like renewable energy. Sometimes they'll have a spread of business into things like short-term lending for property development. Tend to be sort of relatively stable, not risk-free, but sort of relatively low return. The point is to sort of gain the inheritance tax relief rather than to make lots of money. For Michael and Andrea, and particularly Andrea, having sold this business, that if that was a trading company, that would probably have the value of that business would have qualified for business relief. So if she reinvests the proceeds from that within 3 years of the sale, she'll actually get immediate inheritance tax relief on that investment rather than having to wait 2 years. So yeah, the advantages of this is that actually in most cases they'll be able to realize the assets if they need the money, which speaks to the potential need for care in the future.
Absolutely, and I really like the point you've just made there, Angus, about for Andrea having sold the business 3-year period and reinvesting, because as someone who tends to focus in on tax because that's more our role, headline is that prior to the sale of the business, that the value of that would have qualified for business relief, and so Andrea has really just converted an IHT free asset into cash, which is subject to IHT. So having an option that she can restore that business relief on some of the proceeds, that's a really neat sort of rollover trick there, isn't it?
Yeah, absolutely.
So we're then
okay,
on to
so the other sort of substantial action that we've agreed is to set up a trust, and a particular type of trust called a discounted gift trust, which through sort of fairly sort of technical means puts money immediately outside the estate and enables Michael and Andrea to have a regular fixed payment of, I'm going to put income in inverted commas because it's actually a capital payment, and any money that's in the trust, any investment growth that is received will be exempt from inheritance tax, and then after the 7-year period has passed, the entire value will be inheritance tax free, but Michael and Andrea will continue to receive the agreed income payment for the rest of their lives. Yeah, so in summary, the benefits are sort of obvious. To explain it all in technicality would take us about half an hour, so let's not do that in great detail. But so assume that they decide they're going to put £250,000 in, and say, well, I'd like 4% of that back a year for our lifetimes, gives them an income of £10,000 a year from this arrangement. They will, because they're reserving the right to have some money back in the form of this stream of income, that has a capital value today, and they are deemed not to have given that capital value away. So that is known, that value today is known as the discount. And so for illustrative purposes, it might be that the discount is £100,000. Now, actually, in practice, it may well be more than that because they're only in their late 60s. They could well still be around for another 20 years. So the value of a stream of income it may be relatively high. So what happens is that from day one, the gift is not 250,000. The gift for inheritance tax purposes in this illustration is 150,000. So that's the amount that would go on the inheritance tax return if they died within 7 years. So theoretically, there's an immediate saving on this 250,000 of 40% of 100,000. So £40,000 reduction in the inheritance tax bill straight away. And then 7 years hence, the entire value is outside the estate. So yeah, simply put, it's quite a valuable, useful arrangement. Takes a bit of work to get it set up, but it's definitely something we've seen working very well over the years.
Yeah, discounting. I'm glad you've explained that as well as you have. There's something that still make my head hurt a little bit. And I don't envy the people who have to calculate these discounts. I think it's probably just really a preamble to some later slides. We've put there the word income in inverted commas, and that's because whilst Michael and Andrea would be receiving £10,000 a year, and so it would feel like income to them, for tax purposes it's not seen as true income, is it, in terms of...
That's correct. So you couldn't then give it away and say I'm giving gifts out of surplus income because this is capital.
Yeah,
but
that's just
again,
an important distinction.
Too lost in the weeds there.
Yes, sorry. So basically, where are they? So let's assume there were no unfortunate accidents. Mr. and Mrs. Smith are both still here 7 years later. So we've ignored any inflationary increases. Where are they? So the house they've still got, stocks and shares ISA they've still got. They decided, as Angus had run through, to make a business relief qualifying investment into some AIM shares for £150,000, which, whilst still an asset, are now free from inheritance tax, and their cash savings have been reduced because they've made the AIM investment. They've given £200,000 to their children, and they've also put £250,000 into this discounted gift trust. So that quite neatly brings their assets there to the 2 million threshold, and they still haven't touched their pension funds. So after all of this, the inheritance tax payable, once you take out the AIM portfolio, is 40% of 1.85 million, which is 340,000. So it's an IHT. I've put saving there, but really it should say reduction. IHT reduction of 330,000. Whilst actually, as you can see from the income side, and I'm not going to run through those figures in detail, they've still retained their desired income levels and sufficient capital should they need to fund anything further in the future. So through some quite sort of careful planning there, we seem to have ticked the various objectives. And because they now have an estate at 2 million, they benefit from the full residential nil rate band. So that's given them an extra sort of tax-free allowance coming off the inheritance tax bill there. Have you got anything to add, Angus?
Yeah, well, what I would say is that, I mean, we've looked at a couple of things. There are any number of different combinations or plans you can do depending on one's individual sort of risk appetite, how you feel about the amount of inheritance tax payable. So, you know, advice is valuable in this area. I think I do come across people who simply say, I'll just keep giving it to my children because I trust them, because that just seems to be the easiest thing to do. The other thing to add is, you know, we've used an example of a discounted gift trust where the client wants a regular income from it. There are other sort of trust arrangements where you can have some money back, but you don't have to. So it's a bit more flexible. There is nowhere near enough time to go into all of those. But it all comes down to one's individual circumstances.
Absolutely. And similarly, you know, we're seeing the people will probably have heard of family investment companies alongside trusts. And again, we didn't have time today to go into those in detail, but they're another option that can be used. Yeah. So I think,
and finally,
and well, indeed. So looking at the income there, if we were to then assume, as it wouldn't be unusual, that actually now that we're Michael and Andrea are in mid-70s, they've decided they're going to start drawing down just a small amount on their pensions. So it might take their annual income to sort of 60,000, and that's fine. But as we saw earlier on, they don't need that much at the moment, and so this is something that we do see, and it's what we sort of call the creep factor, is that people do some planning and they think, oh yes, that's all fine, and then actually a few years goes by where they don't use all of their income, and that the excess just sits in a savings account, and suddenly they find that actually they have gone back over the 2 million threshold for the residence nil rate band, as an example, or something else, and suddenly a bit more is subject to inheritance tax. So we've touched upon it a couple of times. A common strategy for stopping the position getting any worse is making regular gifts out of income, which on the face of it sounds very straightforward, Angus, but in reality...
Yeah, so here's the theory. If you've got income, and specifically income, so I'm aware of a bit of anomaly with Michael and Andrea because they're receiving a capital payment back from this discounted gift trust, but let's just jump over that hurdle. Supposing your income is 50,000 a year, but your spending is 40,000 a year, there's £10,000 of spare income a year, which is, as Ian says, is you if that keeps piling up in your bank account, it becomes capital essentially as each year goes by. As soon as you stick it in a savings account, it effectively becomes capital. If you then give it away in a future tax year, it's a capital gift. So if you want to, you can, or your executors rather, could claim, if you choose to give surplus income away on a regular basis, year by year. The amounts can vary, but they do need to be regular. You can claim an exemption for that money, regardless of the amount. You know, it could be 50, 60, 70,000 a year if you've got that much spare income. But it's not automatic. You need to claim it. You need to declare the gifts that are made, and it needs to be claimed on the IHT 403 form. And this table here is an extract from that, which essentially tells you the information that will need to be given to HMRC to claim this exemption. So you need to show the person's income from all sources, including non-taxable sources like ISAs, which will not appear on their tax return. So you need to take what's on their tax return for the year, if they have one, or their P60s from pensions, and any income from ISAs, and list their spending under those various categories that you can see there, and keep these records, or have these records for up to 8 tax years, which is allowing for 7 years of the gift allowance of the 7-year rule, plus if you're starting partway through a tax year. So if you are in the position where you have excess income that you want to give away, I would suggest, in order to make your children's or your executors' lives even remotely straightforward, you do need to keep records along these lines. I think that's enough detail that I'm going to go into for now. What this is a commonly talked about relief that is probably not used that often, because if you're giving away 3,000 a year, there's an automatic exemption anyway. It becomes relevant when the amounts are considerably more than that, and it may well be worth, in terms and measurable in terms of several £1,000s of inheritance tax saved, it may well be worth keeping the records to allow your executors to claim this on your behalf.
Absolutely. No, I think that's a clear summary. I'm conscious that the table that we've put in the slides there, hopefully you can see that okay. But actually, along with the slides, which I think will be circulated afterwards, we will include a PDF with this on, just so that you can have a look at the headings there in a bit more detail if they're not entirely clear. So in sort of conclusion then, just picking up what we've covered today. So chances are, whilst neither Angus nor I have a crystal ball, it looks like inheritance tax is probably here to stay. There might be some changes to it, but it's very unlikely to be scrapped altogether. As Angus has said, we've picked up on maybe 4 or 5 options here of hundreds, if not thousands, of different strategies. And actually, we've got some quite small options. And what I would say is sort of stopping the position getting any worse, such as the gifts out of income. And then we've got the larger or more complex strategies, such as discounted gift trusts, for example. so there are a whole raft of options for you to consider, but our sort of overarching message would always be make sure that you put yourselves first when you're looking at this planning. Remember, you're sort of, in effect, you're number one, and you want to make sure that you've got enough to live the life you want to live for however long you've got left.
Absolutely. In fact, one thing to add is a really good way of making sure that inheritance tax payable on your assets is to have less assets by spending it.
Absolutely.
That's not such a bad plan.
No, quite. And as Angus said earlier on, just tell your children that that's what you're doing as well.
Well, it's up to you.
So I think that probably wraps up most of the webinar. But as I say, we've got time for Q&A. I should have said, I can see several people have found it on your sort of Zoom taskbar, that there is a Q&A section. Please feel free to type any questions in there, and we'll do our best to cover them.
I'm going to fire the first question on this list to you, actually, Ian. So sorry, Ian.
No, go
on. What would be the position if Andrea still owned her business? Would the money in the business still be counted for IHT purposes?
So it's a really, really good question. Because we've assumed here that Andrea held all of the shares in her own incorporated trading business, if she still owned all of those when she passed, the business would be valued, and most of the time the value of that business is then covered by business relief and therefore exempt from inheritance tax. Really, the one scenario that we do see is if the business is holding a far higher than expected or required level of cash. So I'm going to use some wildly outlandish figures, but let's say the working capital requirement for the business was £100,000 and it had £1 million of cash in the bank. HMRC would deem there to have been surplus income in there that the business didn't need, and they may well say, well, actually, no, look, you've deliberately left that in the business. You've not taken it out through other means, i.e. dividends or salary, whatever. And so that surplus income is still subject to inheritance tax, but we'll give you the rest of the value of the business. Clearly, I've used some sort of quite wild examples there. It's not something that gets challenged regularly, but it is something to be aware of. And if you think you might be in that position of a company holding sort of excess funds, then it's definitely worth having a chat.
Very good.
I think the second one, Angus, I'm going to chuck your way, if I may.
Okay, so this is what records do HMRC require to prove the 7-year period has passed? That's a good one. Well, you're asked, I believe, to declare on the inheritance tax return any capital gifts made and when they were made, the amounts, etc. And as an executor, you're under a legal obligation to declare those gifts in the last 7 years, but you're not, as I understand it, required to declare any gifts that are more than 7 years old. What people tend to do is keep a spreadsheet, essentially, keep a record of what gifts you've made and when. And that'll be a rolling, if you're making gifts sort of routinely or sort of ad hoc amounts, just keep that record, and then it'll be hopefully obvious for your executors what they need to declare. I mean, if you really want to, you could back it up with a bank statement that shows the money leaving the account. I think it would be, and I have to say, I'm not been involved in sort of practically in terms of what happens if, but I think if HMRC sort of is feeling a bit like something needs a bit more investigation, they can investigate if they think something's not been declared correctly. But I suspect unless the amounts being claimed are fairly significant, then they probably wouldn't investigate. Or, you know, if they have some reason to suspect that you gave a large sum of money and it ought to be counted for some reason, and then they would investigate. But they'll, I believe, ordinarily take what's declared on the inheritance tax return.
Absolutely. If I might jump in with another one, Angus.
Yeah, go ahead.
I had a question. Do beneficiaries of an estate have to pay capital gains tax on inherited property? So the short answer is yes. If they sell, so if you inherit a property and then sell it, yes, that sale is subject to capital gains tax in the normal way, but you will inherit the property at its probate value, which should be its market value as at the date that somebody passed. So if Mr. X died at the end of September and left his house to his daughter, for example, she would inherit it at the value of the 30th of September, and assuming she sells it quite quickly and it sells for the same value that it was valued at on death, then no capital gains tax would be paid. If clearly she holds it for 10, 15, 20 years and there's a big value change, then capital gains tax would be calculated in the normal way. I think that.
Yeah, I mean, assuming that they haven't then gone to live in it and it's become their main residence, or that, you know, that kind of thing. The other thing I've come across, I don't know whether, is if the property's sort of sold in relatively short order after probate, but at a significantly higher value than was declared for probate, what then?
It depends on the reasons for the increase. If it transpires that it should have been valued at a higher value for probate and it was incorrectly valued at a lower value, then you're into the realms of needing to correct the inheritance tax forms that were submitted. If it's market changes post the date of death that have driven, because I mean we have to remember here to get probate granted can take 6-7 months by the time you filled in the forms, submitted them, and everything else.
Yeah, and you can't sell that. You can't sell the property generally until you've got that grant of probate.
No, so you could be looking at anywhere between sort of 7 months and a year to sell a property. If the market changes have driven a big increase, then that's just as it is. But yes, it would then be subject to capital gains tax on that increase in value payable by the beneficiary.
Yeah. Okay. We've got a few
we have
very good questions here.
Yeah, I think looking at the time, the person who's asked about the property portfolio, I'd quite like, if they don't mind, if they could drop me an email, and my email address is shown on the slide, or drop both of us an email. There's so many what ifs. It depends on the nature of the properties and everything else. So that would be quite useful to pick up separately.
Yeah, I mean the challenge is that they're not liquid, so it makes, and there's potentially capital gains on them, so it can be a bit of a challenge to effectively deal with inheritance tax on property. But yes, I think that's what Ian suggested is probably the best way to address that question.
The top one I think is probably quite straightforward to answer, in that I think there's a bit of a misconception there. So we've got a question that linking back to our last week's webinar, if you die and you as the rules currently stand, you're over the age of 75 and you leave pensions to some beneficiaries, then as they draw the income down on those, they will pay tax at their marginal rates.
That's broadly the position, yeah, and is expected to be sort of post the change in the new rules.
Right, yeah. The question we've then got is, if ISAs are inherited, does the recipient have to pay tax on those, and does it ever make sense to switch the drawdown of pensions and ISAs to maximise ISAs? Now, this is ISAs can't, with the exception of a spouse, which is a very sort of specific exemption. ISAs, when somebody dies and leaves an ISA to somebody who isn't a spouse, it loses its ISA status.
Yeah.
So
it's just money or investments at that point.
So ISAs themselves are subject to inheritance tax to the extent that your estate is above the basic rate band, and in the hands of the beneficiary, as Angus said, it's either cash or then just an investment outside of an ISA wrapper. So hopefully that sort of answers your question.
Yeah. The money would just be subject to income tax or capital gains tax for the recipient, ongoing, with potentially inheritance tax having been paid on their value when the estate was administered.
Yeah,
I hope that answers it.
And then finally, what do the insurance policies typically cost to outlive the 7-year rule? Is it a percentage of the value to cover?
Well, as ever with insurance, life insurance, it depends on the age when you do it. Your health is relevant. So I'm fairly sure that the person asking the question is a client of ours. So probably the best thing to do, if it's okay, is that their advisor at our end can get in touch with them directly to talk about it. Okay. Yeah.
So I think that then wraps up the Q&A, and all that's really left is to say thank you very much for attending and supporting us, as always. Hopefully you found the webinar useful. Our email addresses have been up on the screen for some time. Please do drop us a note if you've got any queries, and we'll do our best to help. But yeah, thank you, and hopefully see you again next time.
Thank you, Ian. Very well governed, as ever.